Hello everyone, welcome to my YouTube channel Indian Bull vs Bear. In today's video, I'll share my analysis of historical trends of the automobile sector. This video is part of the series The Final Missing Piece. Before moving on, please read the entire disclaimer carefully. The automobile sector in India is one of the largest in the world, contributing significantly to the country's GDP and employment. It includes a broad range of companies manufacturing passenger vehicles, commercial vehicles, two-wheeler and three-wheelers, and auto components. Government supports the sector with policies like FAME 2 subsidies and PLI schemes. The key growth drivers for this sector includes EV adoption, urbanization and income growth, exports expansion, and tech and R&D investments. The key challenges that the sector faces includes raw material cost volatility, global chip shortage, EV infrastructure gaps, and regulatory norms. So now in order to identify trends in this sector, I will present two graphs. They are the end result of my analysis of the share price movement of last 10 years of top 10 companies of the sector. The top 10 companies of the sector comprises of 9 large cap and 1 mid cap companies. The first graph will show the yearly returns, whereas the second graph will show the monthly returns. So let's start with the first graph, which is the yearly returns graph. So here it is. The green bars in this graph shows the positive yearly returns. The red bar shows the negative yearly returns. The orange line down here at the bottom shows the cumulative returns. The green line shows number of months with positive returns, and the red line shows number of months with negative returns. So let's start with 2015. 2015 was a decent year for this sector, as the sector managed to give returns of 16.36% in that year, with 6 positive months and 6 negative months. 2016 too was a decent year, a bit better than 2015, but not much. And the sector managed to give returns of 19.91% with 8 positive months and 4 negative months. 2017 was a very good year for the sector, as the sector managed to give returns of 53.28% with 9 out of 12 months giving positive returns and only 3 months giving negative returns. But then 2018 and 2019 were bad years for the sector, especially 2018, as it gave negative returns of 21.05% with 9 negative months and only 3 positive months. 2019 too was a bad year with minus 7.88% returns with 7 positive months and only 5 negative months. The sector recovered in 2020, and the sector managed to give well above average returns of 26.31% with 9 positive months and only 3 negative months. 2021 too was a decent year for the sector, as the sector managed to give returns of 22.65% in that year with 7 positive months and 5 negative months. 2022 was similar to the previous year of 2021, and it managed to give returns of 20.76% with 8 positive months and 4 negative months. 2023 was a very good year for this sector, as the sector gave returns of 65.92% in that year with 9 positive months and 3 negative months. 2024 too was a good year for the sector, as the sector managed to give 30.32% returns with 8 positive months and 4 negative months. If we follow this orange line over here, and we see that the cumulative returns for the last 10 years are 529.20%, which is just over 6x. Let's see the key takeaways. So we have just seen cumulative returns of 529.20, which is 6x in the last 10 years. CAGR of 20.19. So uh, this cannot be called as more than an average CAGR, because several sectors have CAGR better than this. So it's at best average CAGR, I would say, for the last 10 years. Net negative yearly returns 2 times. So the sector managed to give net negative yearly returns in 2018 and 2019. In 2018, it gave minus 21.05, and in 2019, it gave minus 7.88%. Best year for the sector was 2023, clearly with 65.92% returns, 9 positive months and only 3 negative months. The worst year was 2018, and clearly 2018 was the worst year for this sector, and it gave minus 21.05% returns in that year, with 9 months giving negative returns and only 3 giving positive returns. And positive to negative year ratio is 4 is to 1, so this is not that bad. This means 4 positive years against every one negative year in the last 10 years. So we have seen worse. So this is okay, I guess. Now let's move on to the monthly returns graph, and let's see how the sector has performed over months in the last 10 years. So this is the monthly returns graph. The green bars here shows the positive mean monthly return. The red bar shows the negative mean monthly returns. The green line shows number of years with positive returns, and the red line shows number of years with negative returns. So let's start with January. January over the last 10 years has given an average return of 2.15% with 7 positive years and 3 negative years. So an average month for the sector, I would say. But February and March are bad months for this sector, as they both have negative average returns over the last 10 years, with February having the negative average returns of minus 1.12%, with 6 years giving negative returns and only 4 gave positive returns. March is even worse, with minus 2.24% average returns, again with 6 negative years and only 4 positive years. The situation improves a lot in April, and the average return for April over the last 10 years is 5.73%, with 8 years giving positive returns and only 2 giving negative returns. For May, it's 4.05%, so another solid month, I would say, with 8 positive years and 2 negative years. June, a decent month with 2.33% average returns, 7 positive years and 3 negative years. July, another average month with 2.07% returns, 7 positive years again, and 3 negative years. August, slightly better than the last couple of months with 3.12% average returns, 6 positive years, and 4 negative years, though. September, below average month, I would say, with 1.51% returns, 7 positive years, and 3 negative years. October, similar to June and July, with 2.22% average returns and 6 positive years and 4 negative years. November, another below average month with 1.6% average returns and 5 positive and 5 negative years. And December is a flat month for this sector with average returns of 0.15% with 5 positive and 5 negative years. So the impression that I'm getting by seeing this chart over this graph over here is that this is quite a defensive sector. It consistently gives returns. There is not much volatility, but the returns are less as well as compared to other sectors. Let's check out the key takeaways. The cheaper months are February and March, clearly, the only 2 months with average negative returns over the last 10 years. December too can be counted as a cheap month. Reason being, it is a flat month, only 0.15% returns, average returns over the last 10 years. The costlier months are April and May. So April with 5.73% average returns and May with 4.05% average returns. Both with 8 positive years in the last 10 years and only 2 negative years each. Now all the other months, see, it's nothing much to actually. It's a quite a defensive sector and minimalistic returns, you would say. But on the plus side, there is less volatility. So I think good for those who likes less risk in life. And finally, the positive to negative month ratio is 1.61 is to 1, which is a decent ratio. That is 1.61 positive months against every one negative month in the last 10 years. That is in the last 120 months. So we have seen worse and we have seen better. But all in all, I would say an okay number for this ratio for the sector. So that is all from my side in this video. Thanks for watching it. If you have liked, then hit the like button, subscribe to the channel, and share it with your family and friends. I'll be back soon with another video. Goodbye for now.